Corning is literally building the physical layer of the AI revolution. I mean, they are the backbone of the modern cloud, yet their stock just suffered a massive 18% single-day wipeout. We are looking at a company that is absolutely dominating the foundational infrastructure of artificial intelligence, a business that is fundamentally crucial to everything tech giants are building right now, and the market still reacted with brutal force. So what exactly is the market so terrified of? Let's get right into it.
Okay, let's dive into this massive disconnect. On July 28, 2026, Corning released their second quarter earnings. And look, by almost every conventional measure, they absolutely crushed it. Core sales hit $4.74 billion, easily beating estimates. Core earnings per share, 78 cents, another beat. Management even raised their long-term targets. And the reward for all this operational excellence? An 18.47% stock crash. To understand why a stellar earnings report triggered such a massive sell-off, we have to pop the hood on the market's underlying expectations.
Which brings us to the core of the issue, the valuation disconnect. What happens when absolute perfection is already priced in?
You see, this crash wasn't about the business fundamentally failing. It was about a valuation that left literally zero margin for error. Leading up to this earnings report, Corning had been on an absolute tear, experiencing a staggering 162% run-up over the previous 12 months. That explosive rally pushed the company's trailing 12-month price-to-earnings ratio to an eye-watering 68.59 times. Now, for context, their 5-year median PE usually sits around 46, so you've got a heavy, capital-intensive manufacturing business suddenly trading at software-like multiples. It created this incredibly precarious setup. When you're priced for perfection, even the slightest hesitation in future guidance is going to trigger heavy profit-taking.
But to really grasp the gravity of this setup, we need to look at Corning's AI economic engine, what we call the physical layer of the cloud.
Before we pinpoint the exact trigger that caused the drop, we've got to understand why the stock ran up 162% in the first place, right? Corning is this highly diversified materials science giant. They operate across 5 restructured segments. They make the ceramic honeycombs you find in automotive exhaust systems, they manufacture high-purity polysilicon for solar cells, and, through their glass innovation segment, they produce the Gorilla Glass that's probably protecting the smartphone in your pocket right now. But today, the undeniable star of the show, and really the entire reason the AI market cares so much about this stock, is their optical communications segment.
And the crucial point here comes down to one staggering metric. Generative AI server clusters require anywhere from 10 to 36 times more optical fiber than your standard cloud data center. Why? Because the GPUs training these massive AI models require ultra-low latency and exceptionally high bandwidth just to talk to each other. We are looking at GPU bandwidth requirements jumping from 0.4 terabits per second today all the way to 3.2 terabits per second by 2030. Copper cables simply cannot handle that kind of thermal and bandwidth load over distance. The AI build-out literally physically requires an ocean of optical fiber, and Corning is standing right there with the biggest bucket.
And they defend this massive market share with an incredibly deep economic moat, rooted in their proprietary manufacturing. It's called the fusion draw process. It's this continuous, gravity-fed method that creates ultra-thin, perfectly flat glass without the need for costly post-draw polishing. Now, getting this setup requires a massive initial capital outlay, but once it's up and running at high utilization, it creates a structural cost advantage and incredible economies of scale. Lower-cost competitors simply cannot replicate these yields without facing massive, completely unprofitable scrap rates.
Corning locks in that structural advantage with a formidable intellectual property portfolio. We're talking over 12,000 active patents. They command roughly 30% of the entire global optical fiber market. And they don't just sell to anyone. They form deep, multi-year, multi-billion-dollar supply agreements with the hyperscalers, specifically Meta and Amazon. Furthermore, they're pioneering something called co-packaged optics, or CPO, which brings the optical connection directly inside the chip package. That specific photonics market represents a massive new $10 billion total addressable market for Corning by the year 2030.
So, the moat is real. Now let's do an earnings reality check and look at Q2 2026 by the numbers.
The business quality is undeniable, and those AI tailwinds are huge. So let's look at the actual financial reality behind that 18% stock drop. As we established, the top-line numbers for July 28th were fantastic. Core sales of $4.74 billion, core EPS of 78 cents. But the real story, it's inside the segments.
Optical Communications saw its net sales jump 32.3% year over year. And because of that incredible operating leverage we just talked about, Optical segment net income expanded by an explosive 77.3%. Make no mistake, enterprise network demand for generative AI connectivity literally drove this massive profit expansion.
Management was actually so confident in this surging demand that CFO Ed Schlensinger announced they expect to hit their massive Springboard target, which is an annualized revenue run rate of $20 billion by the end of 2026. That is a full quarter earlier than they originally projected. To meet this insatiable demand, CEO Wendell Weeks outlined an aggressive capital expenditure plan, ramping up CapEx to approximately $2 billion for the fiscal year, purely just to build enough manufacturing capacity to keep up.
And yet, here is the exact trigger for the sell-off. Management issued their guidance for the third quarter of 2026. They projected a core sales range with a midpoint of $4.95 billion. Wall Street consensus was sitting at $5.00 billion. That's it, a $50 million miss on a $5 billion forward projection. But remember what we said earlier? When your stock is trading at nearly 69 times earnings after a 162% run-up, a $50 million guidance miss is all the excuse jittery investors need to aggressively dump the stock and lock in their profits.
Let's move on to our qualitative business scorecard to measure the actual foundation here. We need to evaluate the underlying foundation of this business to determine if this sell-off is a genuine warning sign or just a mathematical opportunity. Synthesizing the research, the business scores a very solid 7.8 out of 10 overall. Market position and growth outlook are incredibly strong, scoring a 9 out of 10 given their near monopoly in premium glass and fiber. However, I definitely want to call your attention to the management alignment score, which is a noticeably weaker 6 out of 10. While CEO Wendell Weeks has been at the helm for over 20 years providing great stability, he also exercised options and sold $18.6 million worth of stock in June 2026, right before this earnings report. Insiders currently hold less than 0.1% of shares outstanding, which is absolutely something to keep an eye on. And hey, by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's look at our 5-year scenario analysis, mapping the math to 2030. But before we start, I must clearly state up front, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
So compared to the current price of roughly $123, our high case implies a future price of $172.62. To justify that roughly 40% 5-year growth, which is about 7% annualized, Corning has to flawlessly execute its Springboard plan. We're talking hitting $40 billion in revenue by 2030, with margins expanding to 15.5% and the market being willing to pay a 24x multiple. On the flip side, the low case projects a pretty devastating drop to $44.03. That represents a negative 64% total return, or about a negative 19% annualized decline. This happens if AI infrastructure spending softens, hyperscalers pull back, revenues only reach $23 billion, margins compress to 11%, and the exit multiple drops down to 15x.
But let's focus on the highly probable base case, which we assign a 55% probability. This assumes steady AI optical demand, a recovery in cyclical markets, but normal macroeconomic friction along the way. Operationally, this requires $35 billion in year 5 revenue, a stable 14% core net margin, and an exit PE of 20x, which is right in line with their historical average. If you run that math, it gives us an expected value of $114.49, implying a slight negative return over the next 5 years. So even after that massive crash down to $123, the stock is still trading slightly above our base case expected value. This tells us the stock is still fully valued for its growth. If you want to access the full model with all the detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
Which leads us to the final verdict: risks and thesis breakers.
Because the current valuation leaves very little room for error, the risks carry serious weight here. What are the specific threats that could actually destroy this investment thesis? The biggest, most immediate risk is a CapEx pullback from the hyperscalers. Remember, Corning is spending $2 billion this year just to build capacity for Meta, Amazon, and NVIDIA. If those tech giants suddenly decide the software returns on AI aren't justifying the massive hardware costs and they pause their data center buildouts, Corning will be left holding massive, underutilized facilities and heavy depreciation costs. Early warning signs for this would be a sequential rise in optical inventory or core gross margins dipping below 38%. Additionally, they face constant threats from lower-cost Chinese competitors trying to underprice the commodity fiber markets.
So what does this all mean? Does an 18% drop represent a bargain entry point for the AI physical layer or a necessary return to mathematical reality? Well, Corning is undeniably an exceptional business. They have a profound technological moat, and they are perfectly positioned to capture the physical infrastructure layer of the AI boom. But the market's violent reaction on July 28th wasn't a rejection of the company itself. It was a harsh, necessary correction of a valuation that had priced in a completely flawless future. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.